I'm David Wolfin, President and CEO of Avino Silver and Gold Mines Limited. Avino was incorporated in 1968, so we've been in business a long time. We're considered a small cap or growing mid cap junior silver and gold producer. We have a mine in Mexico. We produce between 2.5 to 2.8 million ounces of silver equivalent on an annual basis. And our tagline is, we have a clear path to transformational growth. It's clear because we own the assets that are going to drive our growth organically. So we're going to go from one producing asset to three within 5 years. And we have a very large resource base, 277 million ounces of silver equivalent in the measured and indicated category, and 94 million ounces in the inferred category. And the project's located in Mexico in a mining friendly jurisdiction. We've been there a long time. We have 100% Mexican labor force, right up to our chief operating officer, who incidentally is a graduate of Colorado School of Mines, one of the top mining schools on the earth.
David, good to see you. We saw you back in September. You're excited then. I guess not much has changed since. It's been a good year for you guys operationally. So maybe let's kind of talk to that, because obviously you don't get to rest. You got to keep going. You got to drive that growth. You got to go from 1 to 3 assets producing. But Q3 numbers, it suggested 21% higher mill throughput, but lower grade feed. So what are you doing in terms of sort of managing that output and I guess revenues ultimately?
Yeah, revenues at all-time high, 21 million US, gross profit of 9.99%. We generated free cash flow of around 5 million, and our all-in sustaining costs is in the low 20s. And so what I'd like to remind everyone is that we've started a new mine 19 kilometers away called La Preciosa, and within 6 months of starting the initial ramp on surface, we're already pulling ore out. It's development ore, it's not mining ore, so there is some dilution, and we're expecting higher grade when we're mining on it, but it is being hauled to the mill 19 kilometers away, and we started processing it. So we expect higher grade than what we've been mining in the past from the Avino mine, and so that could possibly lower our costs in 2026.
So that's quite aggressive. Like Preciosa, I think you shipped 6,700 tons plus there, and you're kind of processing 1 month ahead of schedule, I noticed. So where's that come from? Where's that kind of that biggest kind of acceleration come from?
There's a big resource base there, but we've started on La Gloria and Abundancia veins, so they come right to the surface. So we put a decline ramp in 350 meters, pierce both veins, and cross-cut on them in both directions. So we're pulling ore out as we develop along there, and we're ramping down below so we can do more levels. And so that's where the initial 5 to 6 million tons are coming from.
So, but what are you seeing? You're seeing slightly, one, you said at surface. 2, it's slightly higher the average grade than the resource. So obviously that's great in terms of getting numbers, but you've also got to manage and set expectations. What's that profile look like going forward?
Well, the resource grade was given to us by the previous operator. Coeur Mining they did a feasibility study on a giant open pit mine, and then metal prices went down, so they sold it to us. So there's a lot of dilution in there. So it's a 200 gram resource grade, but we went in to inspect the individual drill cores of those La Gloria and Abundancia veins, and there wasn't much of the samples left because they did so many studies. So we went in and re-drilled them, and we hit some really fantastic holes. I can tell you, let's just see here. There was a intercept of 787 grams of silver and 0.5 gram of gold over 5.22 meters. There was 3 kilograms of silver and 1 gram of gold over 0.8 of a meter. So we know, and we had multiple hits like this, so we know the grade is probably going to be much higher than 202 grams.
Okay, so then to that end, are you still working towards a kind of Q1 resource and reserve estimate?
That's correct on both properties, so Avino and La Preciosa. We qualified as a reporting issuer under 43101. You must have 90 million in revenue without a feasibility study in order to publish reserves. So we've crossed that threshold. So we've got a new reserve estimate coming out in Q1.
Okay, fantastic. And with that, you kind of got this kind of pinch and swell geometry. What's that do for you in terms of planning? Like with stopes and production scheduling, etc.
We were pleasantly surprised with the 5-meter intercepts. So those larger intercepts allow us to do cheaper forms of mining. So where it pinches, you got a shrinkage stope mine. Where it swells, you can cut and fill, or long hole mine. So we're developing that plan as we go based on what the geology gives us.
So with La Preciosa, when do you start to kind of integrate the numbers, the production, the revenue into your guidance for the market?
You'll see a bit of that. We're working on our budgets right now, and you'll see some of that being announced early in the new year. And then actual, because we're feeding the mill, so that will start making its way into our earnings.
Okay, and you've also, I noticed that you've also done a little bit of tidying up. You've been repurchasing some royalty packages as well. If you got the cash, why not? And is it going to have a big impact for
More
you?
blue sky for the shareholders.
Yeah, for sure. In terms of I guess the kind of breakdown of the metals that you're finding, how do you kind of prioritize the order of play? Because we talk about La Preciosa there as well, but you've got other options available to you in terms of how you impress the market in terms of the growth profile, metals output, revenues. You can in terms of efficiencies, in terms of the operations and costs, because ultimately it's going to be about margins. So how do you show off, or how do you flex your muscles on that?
Well, we can't pick and choose the metals. I mean, it all comes out. So right now, 49% of our revenue is from silver, 19% from gold, and 31% from copper. That's going to trend higher as we put in the higher grade silver from La Preciosa. And so silver hit 60 today. So it's a very good margin with our all-in sustaining costs around 23 or 24 dollars.
So do you think, obviously, like year on year, so it was 26% drop in copper due to lower grades, but you're saying it doesn't really matter. It's about the contained metal and the value of that contained metal.
Well, it's mine sequencing. So because this mine's been around a long time, in the mine plan, there's different areas they're going back to while we're ramping down deeper. So it's just temporary. It actually goes higher in copper as we go deeper, based on the drilling that we've done below the bottom developed area of the mine. At level 17, we've surface drilled below that, and it's running higher grade in copper, which is typical for this type of deposit.
Right, and in terms of, obviously, with this kind of free cash flow, or you kind of record cash position and cash that you're generating, how do you kind of allocate that between sort of company development, Avino expansion, and obviously, and the oxide tailing project, for instance? What gives you the biggest bang for your buck?
Well, we were just down last week working on budgets with all the management, so discussing all that. We'll be disclosing our budget soon, but we've more than doubled the exploration budget because we have more money. So we're planning to 20 to 30,000 meters next year, and probably divide between La Preciosa and Avino. And so there's brownfield areas that will expand the resource, and greenfields on the property that we know about that maybe we ran out of money in the past, but we always wanted to go back there. So we'll prioritize based on grade. If we can get higher grade, then that will be top priority for us going forward.
Right. Okay.
And then with operating expenses and sustaining fees, I mean, it's pretty standard, but we've got a fairly modern mining fleet, and we've got credit facilities at Caterpillar and Sandvik, and so we're able to replace equipment and keep the fleet modern as necessary without depleting a lot of cash at any one time.
Right. Okay. And so just going back to what you said about doubling or certainly increasing the exploration budget, is this to chase at depth, or what type of exploration do you
Well,
think
at
you're going to be
Avino, it's
chasing?
at depth and on strike to the east and the west. When our partners ran it in the 70s and 80s, they were a private family, so they didn't spend a lot of money deviating right from the main source of mining because it got more expenses as you had to go away from the main haulage area because of services. Now you need longer cables, electricity, and all that kind of stuff. So they kept it right down the heart of the ore deposit. All those areas on the sides are available, and we're going back and exploring them. And there's other reasons too. To the west, it sits below our tailings pond, and we didn't want to mine below a wet pile of sand and blast it. Now it's been decommissioned, dried out. We've tested some blasting. It's not budging. And so we're going to explore to the west towards this major fault.
So are you are you chasing like another La Gloria or Martha? Or Martha too,
Over at La Preciosa, potentially,
yeah.
yes. That's
Okay.
Well, and drilling the extremities of the vein because Coeur Mining and Pan American before them were considering open pit, and they were looking at Martha, which was a deeper flat-lying vein, on how to get that out. So they considered an open pit. So they didn't spend a lot of time detailed drilling the narrow veins that come to the surface. Well, those are the veins we're mining right now from underground. So there is opportunity to expand them on strike in both direction and at depth.
Right. Okay. And with regards to the tailings, like oxide tailings, which I mentioned earlier, like it's not exactly a big capex project, less than $50 million. And it's a kind of accretive growth rather than stellar. But so what do we know about the oxide tailings? How much have you got? What could that be worth to you?
Yeah, well, we did a pre-feasibility study, so high level of certainty. We have proven and probable reserves of 6.7 million tons. And then the pre-feasibility study was done at 23.45 silver and 18.40 gold, and had a post-tax NPV of 61 million. At spot, it's probably 250 million. And so this is low-hanging fruit, and the all-in sustaining cost will be around $10 once it's built. So it'll be a standalone operation next to Avino, and it'll cost about 50 million, and it'll have leaching tanks. It'll be all enclosed in a building.
So is that, I mean, given your cash position and given what the capex is, clearly you could finance it yourself at a cash, but you probably won't want to do that. Do you think you could get a kind of entire debt package on this thing, given your cash producing elsewhere?
Easy. The bankers are knocking down our door every day right now. Take our money. It's hard to say no considering where we've been, but we're being strategic. We're being orderly in growing our balance sheet organically from the current operation. And we have an ATM, so we've issued some shares, but at higher prices, not at discounts, no warrants, just filling the treasury in anticipation of these expansion plans.
Okay, so you've got some very, very aggressive growth plans. You talk about
in the current mill as well. So we're in our 5-year plan. There was an expansion of about 1,000 to 1,500 tons per day. We have an independent engineering firm evaluating the expansion possibilities and hauling material from La Preciosa rather than building another mill over there. Just seeing how we can max out production at Avino, keep a low footprint so it's good for the community, create more jobs. So it's a benefit to everyone down there.
Okay. And look, obviously, people buying into the growth component of this. The stock's performed well in the last 3 years. Also, notice you've got a bit of increased ETF inclusion. That's got to be helping.
Oh, for sure. We're trading millions of shares a day. We're in 10 different ETFs, all of them that invest in junior silver explorers. We've got large institutions buying our stock. So we've gone, probably 2 years ago, we had less than 10% institutional holding. Now we're at 32%, and it's all organic. We didn't give them shares and take their money. They bought it in the open market.
So tell me, what is the given the profile of the metals that you've got, you also got silver, gold, copper. The pure play silver company seems to be getting extraordinary valuations. Are you a little bit jealous?
Well, we felt that we were unfairly undervalued a few years ago because when we bought La Preciosa, the company that we bought it from held 14 million shares of Avino, and they had debt issues. They were $500 million in debt. So they were selling non-core assets, and they started shopping around our shares, and the shorts built up and drove our share price down. And in October 2023, they crossed out their block, and we bounced since. So how are we valued today? Our PNAV's about 1.2. So if you look at where we're heading, 6 to 8, maybe close to 10 million ounces a year within 5 years, those companies got taken out with PNAVs over 2. MAG, Silvercrest, and Gatos. That's where we want to be.
Okay, well, I look forward to seeing what you do in 2026. Keep the revenue flowing. That's the key to all of this. Appreciate your time, David. Thank you.
Thank you very much.